Greetings, and welcome to the High Flying Tutors Academy channel. Today we will be helping you with the accounting equation, and below are the transactions that we have to record in our answer sheet. Our answer sheet here it is. This is how it looks. So we are going to be recording every transaction of the accounting equation into this answer sheet, right? So we are going to be looking at all this question and answer according to the required part, right? So before you record or before you go and record anything in accounting, you need to be understanding, or you need to understand the principles of every question or every principle of every topic that you are doing. So in the accounting equation, for you to better understand the accounting equation, you need to have an understanding of the elements of financial statements, of which I will explain the principles of the elements of financial statements in this table. But I'm not going to explain a lot. I'm just going to list the elements of financial statements and indicate to you where does it increase and where does it decrease, right? So elements of financial statements, number one, assets. Number one is assets. Number two is owner's equity. Number three it's liabilities. And then number four is it's expense or expenses. Number five is incomes. And then now we've got 5 elements of financial statements. Number one, assets, owner's equity, liabilities, expenses, and incomes, right? And then now we comes to the effects, where we have to determine where does asset increase, where does asset decrease, right? So we only have got two sides, right? So asset increases on the debit side. So where it increases, I'm gonna put plus, right? Asset increase on the debit side, and then it decreases on the credit side. I'm gonna put minus right there. Okay. And then owner's equity increases on the credit side. Increases on the credit side. And then decreases on the debit side, minus this side, right? And then liabilities increases also on the credit side. Liabilities increase on the credit side, decreases on the debit side, minus right there. And then expenses increases on the debit side, decreases on the credit side, right? And then when it comes to incomes increases on the credit side, right? And then decreases on the debit side. So this is what we are going to follow we are going to follow these principles in order to come and record here whether we must debit or credit, and is it plus or minus in terms of the effects in the accounting equation format, right? So now I want us to go and start with question 1 right now. Let's just go and start with question 1, and then we will be relating with the elements when we record. Firstly, we need to determine accounts affected. Either is 2 or more accounts affected in each and every transaction. So now, transaction number 1, they say purchased office equipment on credit for 10,000 rand. So when you purchased something on credit, it means you are owing someone, right? There's a liability there. So 2 accounts affected here is what you have purchased and the method you used to purchase. So the method you used to purchase is on credit. So the people that you are owing are going to be creditors. So it means 2 accounts affected here is going to be equipment or office equipment and creditors, right? So now 2 accounts affected, remember, office equipment or equipment and creditors, or sometimes some other, based on the terminology changes, they call it accounts payable or trade payables, right? So but I'm gonna call it creditors. So now when we come this side, we want to record. Remember, don't forget the date is 1, and then we cannot debit or credit without passing through the elements. So when we record, we are going to ask ourselves, how many accounts affected? 2 is what? Equipment and creditors. Now, number 1, equipment. What are equipments? Equipments are assets. Now we're going to check, are they increasing or decreasing? If we are buying, it means we are bringing more equipment into the business. Therefore, there's an increase in equipment, and equipments are assets. When they increase, we debit. It means we must go and debit our equipment right there. Equipment, right? Just equipment, okay? And then it means we're going to credit what? We're going to credit our creditors. We're going to credit our creditors or accounts payable. Creditors or accounts payable or trade payables, right? So our accounts payables or our creditors are liabilities, and they are increasing because we want to buy on credit. It means there's an increase in people that we are owing, right? So when the people that we are owing are increasing, these people that we are owing are liabilities. Liabilities increases where? On the credit side. Therefore, we are going to credit what? Creditors. We're going to credit creditors. So creditors are liabilities, and then equipment are assets. So we are going to go to the column of the assets. There's an increase in assets of 10,000 rand, right? And then here, owner's equity is not affected. We put 0. What is affected is liability plus 10,000. Remember, both accounts are increasing, but the other one increases on the debit side, the other one increases on the credit side. So this is how you record transaction number 1, right? So let's go to transaction number 2. Let's go to transaction number 2. So transaction number 2, they say to you, received 7,500 from customers in respect of service rendered to them. Received 7,500 from customers in respect of services rendered to them. So you rendered a service for cash. So when you render a service for cash, 2 accounts affected is going to be bank, because you are receiving money. When you receive cash in accounting, accounts affected, bank. And then why did you receive that money? Because you have rendered a service. So 2 accounts affected here is going to be bank and services rendered, right? So let's go and record this transaction of 7,500. Transaction number 2. Transaction number 2 right there. 2 accounts affected, bank and services rendered. So bank is an asset, and it's increasing because we are receiving money. So when we receive money, there's an increase in our bank, right? The balance in the bank will increase because we are receiving money, right? And then Why did we receive money? We have rendered a service. So services rendered is going to be an income, right? It's an income account. So let's record these two accounts. Remember, bank, it's an asset and it's increasing. We debit. And then services rendered. Services rendered. Services rendered, it's an income. We credit. Why? Because there's an increase in assets and there's an increase in incomes, right? So when there's an increase in income and there's an increase in asset, the other one you debit, the other one you credit. All right. So when incomes are increasing, you credit according to the elements right there. And then bank is an asset. When asset increases, you debit. Okay. So now it means we're gonna go to the asset part for bank and say plus 7,500. Okay. And then remember, services rendered is an income account, and when we check on our accounting equation format, we don't have a column for incomes, right? So incomes affect our owner's equity. Incomes affect our owner's equity by increasing it. So we are going to say plus 7,500. So incomes increases owner's equity. Incomes increases owner's equity. So we are going to the owner's equity and say plus 7,500, and then on the liability we don't have any account affected to liability, we put a 0, right? So that is how we record our transaction number 2. Transaction number 3, let's go and check on the question right there. They said the proprietor increased his capital contribution from 200,000 to 300,000 by depositing cash into the bank account of the business. So here the owner is increasing the capital. Is putting more money into the business, of which he put 100,000 because he increased from 200,000 to 300,000. So for us, from 200,000 to 300,000, it means he increased this by 100,000 rand. So two accounts affected. Whenever the owner is contributing money into the business, is capital. So we're going to call it capital. So two accounts affected here is capital and bank. Accounts affected right there for transaction number 3 is capital and bank. So we go to our answer sheet right there. We're going to debit bank because the business has received the money. We're going to say bank. The business has received the money in a form of capital. So bank is an asset, we debit. Capital is an owner's equity account. So there's an increase in owner's equity because the owner is putting more investment or more money into the business. And owner's equity, when it is there, it increases on the credit side. Owner's equity increases on the credit side. So you come on the credit side and say capital or capital. Capital or capital. And then the owner increased this capital by 100,000 because he increased, remember, from 200,000 to 300,000. And then this one is a capital account, it's increasing, plus owner's equity account, and it's increasing, you say plus 100,000 on the owner's equity. And then there is no account that affect our liabilities, we put 0. All right. So we are done. This is how you record transaction number 3. Transaction number 3. That's how you record transaction number 3. And then let's go to the next transaction. So the next transaction is transaction number 4. Transaction number 4, they say issued a check to Aloha Bank to settle the loan account of 35,000. So here you are making a payment to a loan. So when you make a payment to a loan, two accounts affected is going to be loan and bank, because when you make a payment, there's a decrease in your bank balance, right? So accounts affected is going to be bank and loan. So let's go and record this transaction number 4 in our answer sheet right there. Transaction number 4. So now remember, loan is a liability. Loan is a liability account. So whenever liabilities are decreasing, because when you make a payment, it means you are decreasing your people that you are owing, which are liabilities. When liabilities are decreasing, we debit. It means we are going to debit our loan. We're going to debit our loan, and then we credit our bank. We credit our bank because our bank this time is decreasing because we are making a payment. And whenever bank decreases because it's an asset, we credit. So you see, and then we paid, there's a decrease of 35,000 in the bank right there. Okay, and then there's also there's nothing that affect our owner's equity here, and then there will be a decrease in our liabilities of minus 35,000 because loan, the liability, so and it's decreasing. That is why we indicate minus right there. Okay, and then we are done with recording transaction number 4. Remember, we don't just debit or credit, we firstly relate to the elements. All right, so let's go to transaction number 5. Let's go to transaction number 5. Transaction number 5, it says you have received 22,500 from a customer for services that were rendered to her in the previous month. Received 2,500 from a customer for services that were rendered to her in the previous month. So when you receive money from a customer that has been owing you, 2 accounts affected is going to be bank and the customer. The customer that was owing you, we are going to, they are debtors. They are debtors. So you can say debtors control. Debtors control. So 2 accounts affected is going to be bank and debtors, and both of them are assets. Both of them are assets. So let's see how we record this side. And this one is creditors control. Sorry for that. This one is creditors control, because others prefer it to be like this, creditors control. Yes, it must be like this. Okay, and then here transaction number 5, when we record transaction number 5, 2 accounts affected right there is bank and debtors. So the other, these 2 are assets, both of them. The other asset is increasing, the other asset is decreasing. What is it that is increasing here? Is our bank, because we are receiving money, and whenever asset increases we debit. So we're going to say bank, and then the other asset is decreasing. The other asset is decreasing, which is debtors control. Which is debtors control, right? And then now, how do we record? Because both of these are assets. We are not, liability is not affected, owner's equity is not affected. So when we record the assets that are in, the other one is increasing, the other one is decreasing, we're gonna say plus 2,500, and then we're gonna, so below we're gonna say minus 2,500. So that's how you record when 2 assets are decreasing. I mean, the other one is increasing, the other one is decreasing. You're gonna indicate your calculations, or I mean your recordings in this way, right? We're still gonna have the, we're still gonna maintain our format that says asset is equals to owner's equity plus liability, because 2,500 minus 2,500 is gonna give you 0. So it means this 0 plus this 0 is still gonna give us 0. But for the purpose of indicating the recordings and how did we arrive on this answer, we must also indicate the calculations. Don't put it zeros everywhere, right? And then let's go to the next transaction. So the next transaction, transaction number 6, they say bought a computer for office use for cash. This costed 15,800. So you bought a computer. A computer is equipment. Computer is an equipment, right? So 2 accounts affected is going to be bank and equipment. Also here there are 2 assets affected. 2 accounts affected, they are both assets, because computer, which is equipment, is an asset. Cash, which is bank, is an asset. Let's go and record. So transaction number 6. So equipment is an asset. We bought more equipment. So there's an increase in our equipment and is an asset. Whenever asset increases, we debit. So we're gonna say equipment here, equipment, and then we're gonna decrease our bank because we have made a payment. There's a decrease in our bank, and also is an asset. Whenever asset decreases, we credit, right? So now when we record, remember, it's 15,800, so it's gonna be plus 15,800, right? And then also minus 15,800, and then there's no owner's equity affected, there's no liability affected. This is how you record, right? So let's go to the next transaction. I hope you guys understand. And then transaction number 7, they say settled the account of a creditor by means of EFT for 2,800. So here you transferred, you made a payment through transfer, electronic fund transfer. So you've transferred the money. So it means two accounts affected is bank and creditors control, because you made a payment, right, to your creditors. So when you record this transaction number 7, remember, two accounts affected, transaction number 7, two accounts affected is creditors and bank. So but here remember, bank is decreasing and bank is an asset, and then the creditors are decreasing because you are paying them, and they are liabilities. So look, whenever liabilities are decreasing, we debit. So it means we must come here and debit what? Our creditors control. Creditors control. Right? And then we are going to credit our bank because we made a payment. And then we come to our asset, we say bank is an asset and it's decreasing. We're going to say minus 2,800. That's what we paid. And then in this transaction, owner's equity is not affected. There's a decrease in our liabilities because we paid them, right? 2,800. All right. So that's how we record transaction number 7. Please remember, you do not just record, you also have to relate to the or align with the principles of the elements of financial statements. That's how you're going to manage to prepare a good, and you will never get 0 on accounting equation as long as you follow the principles of the elements of financial statements. Right. So let's go to the next transaction. The next transaction is transaction number 8. They say bank charges according to the bank statement amounted to 270. So it means you paid bank charges, because remember, why are they saying bank charges according to the bank statement? Remember, they don't inform you, you just deduct. As you receive your bank statement as a business, you will see, oh, this is the total amount of bank charges that I've paid. So basically in this transaction, you've paid what? Bank charges. So two accounts affected here is bank charges and bank. Bank charges is an expense, bank is an asset. So there's a decrease in bank and there's an increase in expense, right? There's a decrease in bank and increase in expense. So you go there and say 8, transaction number 8. Whenever expenses are increasing, we debit them. Bank charges, and then because they are expenses, right, when they incur or when they increase, we debit. And then bank, because we made a payment, is decreasing, it's an asset. When it decreases, we credit. So it's going to be bank right there. And then bank, we're going to go to the asset part and say minus, because bank is an asset, 270, right? And then we come here on the owner's equity, because remember, bank charges are expenses, and when expenses are increasing, they decrease your owner's equity. Expenses by nature decreases your owner's equity when it comes to the accounting equation. So you're going to say minus 270, I mean 270, I mean to say, not 2000, and then 0 on liability, 0 on liability. So we don't just remember, we always align or relate to principles. We follow the principles of the elements of financial statements in order for us to debit and credit correctly and know which one falls where. Okay, so remember, expenses decreases your owner's equity and incomes increases your owner's equity. All right, and then that means we are moving to transaction number 9, the following transaction. That's how you record transaction number 8, by the way. And then let's go to the next transaction. Transaction number 9, they say the tenant paid the monthly rental to Star Printers 20,000. So you are receiving money from your tenant here. So it's money for rental. So this is two accounts affected. It's going to be rent income and bank, or you can say rent received and bank, right? Rent received or rent income and bank. So remember, bank is an asset and it's increasing because we are receiving money, and whenever asset increases we debit. So we're going to come this side and say bank, right? And then rent income, you credit. Why? Because rent income is an income, and incomes increase on the credit side, income, right? And then when you go to the effects in terms of the asset, owner's equity and liability, bank is increasing, is an asset plus 20,000. And then rent income, it's an income. And remember, we don't have a column for incomes here, right? But remember, incomes increases your owner's equity plus 20,000. And then no liability, you put 0. All right. And then transaction number 10. Let's go to transaction number 10. So transaction number 10, it says invested 250,000 by opening a fixed deposit at Aloha Bank. So you have invested money. So two accounts affected here is bank and fixed deposit. The type of investment you've made is fixed deposit, right? So two accounts affected here is going to be bank and a fixed deposit, right? So how do you record this? These are two assets as well. Are you with me? So there's a decrease in bank because you took money from your bank account to the investment account. So they are all assets. So investment account, which is fixed deposit, is increasing. So you're gonna debit that as an asset, fixed deposit. And then you're gonna credit bank because there's a decrease in bank because you have taken money from the bank, the actual bank account, to the investment account, right? So when you record this, you're gonna say plus 250,000 on the fixed deposit, and then minus 250,000 from the bank account. And then there is no owner's equity affected here, 0. There is no liability affected here, 0. So this is how you record these transactions. All right, this is how you record these transactions, and I hope you guys will understand better. Remember, do not just record when you prepare the accounting equation without trying to relate your stuff, or without relating your account with the elements, so that you can record correctly. So I believe after watching this video, accounting equation is no longer going to be a problem. You are going to make it. This is the better way to record or to prepare your accounting equation. So please do not forget to subscribe, like, and share. And salute.